getting back to the idea of market efficiency, we want to show you some statistics and data behind this. To talk about stock picking, there's a lot of data that shows that stock picking does not give you a higher likelihood of outperformance. We'll just focus on one simple chart. And this is the performance of professional money managers, mutual fund managers, in all of the sort of major categories in the markets. There's a 20-year period ending in 2021, and we're looking at all the different major categories of investing and the professional fund managers in those categories who are trying to beat the index, which is a fixed basket of stocks meant to be representative of that category. So for example, in large caps, the large cap managers, these are professional money managers who pick large cap stocks, and their goal is to outperform the S&P 500, which is representative of the broad market, but it's really representative of 500 of the largest companies in the United States. And the goal of large cap managers is to beat the S&P. Over this 20-year period, only 5.88% of professional large cap managers beat the index that they were trying to beat. The same thing happens in mid cap. Only 8% beat the mid-cap index. In small caps, only 6.5% beat the index. So if you look at this chart, in every category of investing in the public markets, professional money managers have substantially underperformed the index. Your next question might be, well, why don't we just buy the ones that have beaten the index? Well, the data, unfortunately, indicates that those roughly 10% on average that beat the index over one period of time did not have any higher of a likelihood of beating the index or even being in the top half of professional managers in their category over the next 10 years. So there was a study done that looked at large cap growth managers, and stay with me on this because this was done over multiple different categories as well over many different periods of time, where they looked at the performance of large cap growth managers. This is one specific category of investing, and looked at the top 25% of those managers, the second 25, third 25, and the fourth quartile, the worst performing 25% of those managers. How did they do in the next 5 years? Of the top quartile, more than half of them, 58% of them, ended up in the third and fourth quartile in the next 5 years. Of the worst performers, 62% of them ended up in the top two quartiles over the next 5 years. So in other words, the worst performers actually had a higher likelihood of ending up in the top half over the next 5 years. And this study has been done over multiple year periods of time to look at their subsequent performance. It has been done through large cap growth, large cap value, mid cap, small cap, and it found that actually picking the best performing manager of one period of time gave you no higher of a likelihood of performance over the next period of time. So you get back to the reason for this is because, again, the markets are very efficient. They've priced in everything that these managers know, and the top performers over one period of time really are the ones that tended to have gotten luckier. We can conclude that if you buy the index and keep your costs low, you generally have a high likelihood of outperforming any individual professional stock. For more information, please feel free to take a look at our website at www.aireadvisors.com. Thank you and happy investing.